Audley Shaw knows a thing or two about Jamaica's debt. He was the island's Minister of Finance under the Jamaica Labour Party administration between 2007 and 2012. He's now the opposition's spokesman on finance.
So first of all, Mr. Shaw, we hear about the debt all the time. It's a big figure that looms, and people hear the numbers, but they're not quite sure what is it. How much is the debt?
The stock of debt is listed officially now at over 1.7 trillion Jamaican dollars. Somewhere above there. It's heading towards 1.8 trillion dollars. And if it does not include, however, the debt that we are racking up with under the Petrocarib Fund. If you were to include that, that's about 2 billion, close to 2 billion United States dollars, which means you're adding close to 200 billion dollars more. So your real stock of debt, domestic, external, and Petrocarib, is closer to $2 trillion right now.
So to whom does Jamaica owe all this money? And how did the debt accumulate to where it is now? Like many people, I assumed that the bulk of the debt is owed to international creditors like the IMF, the IDB, bondholders, and others. But that's not the case.
Part of what drove the borrowings from 89 to 2007 was borrowing at expensive rates of interest.
What do you consider expensive rates?
Well, as far as I'm concerned, anything that is above single digits is expensive. And so we have a perspective. Let's understand. In the 1990s, the average annual commercial bank lending rate was 53%.
In Jamaica?
In Jamaica, was 53%. That means that the average interest rates that the government would be borrowing money at would probably be maybe 20 points lower than that. So the government's average interest rate for that entire 10-year period would have probably been in the 30% range.
But that's locally. Isn't the bulk of our debt external?
No. In fact, the bulk is local.
With debt and interest piling up, any knowledgeable person would try to renegotiate the terms of the loans to get better interest rates and maybe even a reduction on the principal balance. Enter the Jamaica Debt Exchange in 2010, engineered by then Minister Shaw. It was one of the hallmark achievements of his administration.
That entire stock of domestic debt was priced, the interest rates we were paying on it was between 14 and 28%. The debt exchange brought it down to 12.5%. And we extended the maturities over a longer period of time. But we did not have what you call a haircut. That is to say, I'm not talking about your haircut at all, right? But we didn't have any haircut in the sense that the principal remained sacrosanct.
Now, you said earlier that only single-digit interest rates are acceptable, but you also mentioned that when you negotiated the JDX, that we ended up with about a 12% or 12.5% interest rate. So isn't that JDX interest rate still too high?
It was, but we had to begin somewhere. And in fact, that's a very good question, because it was a process of phasing down, because what we had to be careful about in that debt exchange, we had to be careful that we did not destroy the equity base of the companies. Remember, this was all domestic debt, so this is all Jamaican companies.
So you said that the JDX at 12% was supposed to be kind of a phase one of lower interest rates, and that it was like a whetting of the appetite of our creditors. Is it time now then for a second phase, bringing our creditors back to the table and negotiating what some have called JDX 2.0?
The minister has finally admitted to a number of things in a kind of a circuitous way. He has placed on the table, post-cabinet press retreat, that one of the things that they are discussing with the International Monetary Fund is the question of a liability management program. Now, what's a liability management program? Another JDX. That's what it is.
This is the statement to which Shaw alluded. Finance Minister Dr. Peter Phillips made the comments during a press conference after a cabinet retreat in the early part of January.
Remaining under discussion is the issue of voluntary liability management operations in relation to the debt. Let me make it clear, since there are lots of rumors around, no haircut is contemplated. As I have indicated, we are engaged and will be engaged further in voluntary and necessary debt liability management because, as we said, sacrifices will have to be borne by all.
Before I departed as minister, the next area we were looking at for a liability management program was on the external debt side. And let me tell you why. On the external debt side, we had too many instruments that were priced in double digits.
Now, getting creditors to give a discount on the debt is one thing, but some have suggested that Jamaica, unable to afford the payments, should simply default. It's what Argentina did in 2001 on a large part of a $132 billion debt in the middle of that country's economic turmoil. More recently, in 2012, Greece defaulted on much of its debt, prompting numerous comparisons with Jamaica. The Chicago Tribune called Jamaica the Greece of the Western Hemisphere. But Shaw says the government cannot allow a default.
You can't do that because you'd wreck the country's reputation. It would be a major it would be a major reputational issue, and it would mean that the country would be blacklisted. You'll be blacklisted by private investors who lend money to emerging market economies. You'll be blacklisted by the multilateral institutions who don't support that kind of behavior. And then you'll be sort of left on your own. I think that I think what you would see there is a dangerous prospect. What you would see there is a country that would be plunged deeper and deeper into poverty. Does it surprise you to know that approximately 80% of our entire stock of domestic and external debt are held by Jamaicans? We think they're held by foreigners abroad. Majority of it is held by Jamaicans in Jamaica. So complete default, you totally destroy the financial system. Can't go there.
But don't we need to prepare for the possibility that negotiating a new agreement with the IMF ends up taking much, much longer than expected, or in the worst case scenario doesn't happen at all because this administration is having the same problems that your administration had in implementing wage restraint, public sector reform, tax reform, and those things? Don't we need to prepare for a worst case scenario then?
The minister is fiddling while Rome burns. There at some point you have to stop negotiating and you have to say, here's a position beyond which we can go no further.
So can we take that same approach with our creditors? Since everybody has to take less, public sector workers have to take less, shouldn't our creditors, because we don't have the money, have to take less as well?
But then be fair to the creditors. Be fair to the creditors as well. They have already demonstrated that they are taking less, right? But you need some truth from the trade unions too.
All right, Mr. Shaw, let's have your final word.
It's time now to forget about minor repairs, go for major overhaul. It's time now to forget about Band-Aid type things that are populist. It is the old propensity of this government in populism to go with Band-Aid. Leave Band-Aid alone and go for major surgery.